Hello and welcome to the latest episode of Millennial Money, which is the show where we take your questions and we discuss everything to do with money for millennials.
This week we're going to discuss credit card debt and having an overdraft and how that affects when it comes to making a decision about getting a mortgage, and also asset allocation for pensions when you're in your 20s. That's another question we'll be covering today. So Damien, someone sent in, they want to know what decisions they need to make. How would you go about asset allocation for a pension when you're in your 20s? And also, first of all, please explain to us, what the hell does that mean? What is asset allocation? What is that person talking about?
But before I start, can we just focus on Lauren's mug? We've got a bit of a plug for our Money to the Masses mug here. It's the first time Lauren's drunk tea.
It's a bit of lipstick on this
lipstick
one,
on
yeah.
there. Asset allocation is basically a term that describes what sort of assets in terms of equities, shares, geographical locations of things that you have in your pension or ISA. So it's the mix that you have. So if you have a pension or an ISA, then it's basically a box, and that box is a tax wrapper that has some form of tax incentive or tax advantageous status. But what you put in it is what actually determines how much money you make or lose. And so that can be UK equities, which is shares of companies in the UK. It could be things like bonds. It can be types of commercial property. So that's what the asset mix or asset allocation is. Now, different types of assets have different risk levels. So shares are up the risky end, so they go up and down, but they're very volatile. Cash is down the lower end, and then you have bonds, then you have things like property, and you can slowly move up. And different types of equity, so emerging markets, are more risky than, say, things in the UK or America, so developed world equities. So asset allocation is how you decide which or how much you'll have in each type of asset and the mix. And there's no hard and fast rule about it, but it's to do with your own risk level, so how much risk you want to take personally. If you're very risky, you're going to have a lot of the risky assets. If you're going to be sort of risk averse, then you're going to have a lot more of the stuff down the low risk end. Generally speaking, what you want is a mix that is diversified. So you have a bit of everything, because normally when one thing goes up, something else will go down. So if the stock market's crashing, then if you have bonds or cash or property in your portfolio, then they may be actually going up, or they won't be falling as much. So it actually means that you can ride the sort of ups and downs of markets. Now, determining your asset mix is based upon your own risk level, so you have to assess that. But it also is reflective of your age as well, the term you've got until you want to take the money out. So if you're talking about a pension, then if you're young, you can afford to take more risk, because if the stock market collapses, which it will do every now and then, it will fall 10-20%, you will have time for it to recover, because these cycles happen every sort of decade or so. There's no set frequency, but they do occur. So for somebody in their 20s, as a kind of general rule, this isn't advice, this is just a general rule, you would probably move towards the high risk end, because if you're going to put it in your pension, you're probably not going to take it out to your 55-60. That means you can take a bit more risk and the market can come back. Now, how do you work out what the exact numbers, how much you have in asset in UK equities, how much you may have in American equities, how much you have in bonds? That's quite tricky. But what we did, if you go to moneytothemasses.com and search for investment asset allocation tool, we built a tool that what it does is it takes what some of the passive investments out there, what they do for different asset mixes and asset allocations for a balanced kind of person. And we built a calculator off the back of that if you put in your age, it would come up with some sort of suggestion based upon those funds and what the sort of brains out there think is a good asset mix. It's not advice, as I say, but one thing it's based upon is a general rule of thumb, which is even used in the city as a basis for a lot of asset allocation. What you do is you take your age and you minus that from 100. So if you're 20, then you take that away from 100, that gives you 80. Now 80 is about the percentage you should have in high risk and medium risk investments, so things like equities, and the other 20% would be in the low risk and so cash and bonds, etc. So the tool that we have takes that, puts in your age, your risk profile, and it will come up with something that's based upon sort of the general thinking out there.
Okay, so actually I've been thinking, I've just realised now that you've explained pension, in my head I've always thought of a pension as literally there's a box over there that is your pension, and the only way that you pay into your pension is via work. In my head, that was a pension, and now that is obviously a workplace pension. So when sometimes people refer to their pension, they're actually just referring to money that they're preparing for their retirement, rather than actually being a pension.
Well, it could be, but normally it would be in a pension. They might be sitting there thinking their workplace one, they can pay into it. But what it is, it's a box. It's some people save for retirement via ISAs, but that is a different thing. So yeah, there is a pension as a box, if you think of it, which you've got to put stuff in, and it's what you put in that box, with the mix of asset mix, the things that will make it grow. Otherwise, it will just be a box with money in it that's not doing anything. And actually, what you have in an ISA and a pension, that mix, the stuff inside can be the same.
Yeah.
And so you can have different wrappers and different boxes, basically.
But who decides what you put in that pension and in that box? Because obviously I pay into a pension and I haven't made any of those decisions about asset allocation.
Yeah.
So what's the difference between my pension that I pay in now and I've paid into before, where I don't make those decisions, and the viewer who makes those decisions on asset allocation? What's different about his pension? Has he got it from someone else, somewhere else, that gives him the opportunity to choose where his assets are?
It's a good question. What happens often in some pensions, if it's workplace ones, there'll be a default fund, one you'll go in, or you may have gone into a managed fund, which is a fund that does all that asset mix in one lump. So they'll call it managed because someone runs it and they do a bit of everything. Right. And of course, you won't not realise that. And most people, Lauren, don't realise they're in just a general fund.
Yeah.
But they could make that choice if they want. They could choose to pick where it goes. So someone might choose to invest in something like US equities, the next Facebook or whatever. They have a choice. Right. What it really boils down to is most people don't realise they can make that choice, and they have those choices. So if you found your pension that you're paying into, you will have a set of choices depending on the pension itself that you could go and invest in. Because I know for a fact that yours isn't what they call a final salary scheme, which most people don't have. Yeah. Millennials, you'll be lucky to ever have one, which is one where it isn't based upon, you don't really choose what you're investing, it's based upon your salary, the amount you get as a pension pot. But for everybody else, what they call a defined contribution scheme, you can choose. So the message is, go and look at your pension and go and look at your choices.
So finally, our next question, someone wanted to know, does having debt on their credit card and having a substantial overdraft affect them when they come to make the decision about a mortgage?
Simple answer is yes. If you've got to think about that, a mortgage is a form of debt. So you're taking out a massive loan to buy a house. And what will happen is the mortgage lender is going to assess whether you're a risk or how much of a risk you are and whether you're going to pay it back. Yeah. So the way they do that is they look at your credit report. And that is the report. You can go and get them on free online from places like Nodal and all various other ones, Experian, and it will be a history of all the credit you've taken out. And they look at that, and they look at how you manage your credit, how much you have, and the availability of the credit you can get access to, and decide whether you're a risk and whether they want to lend to you or not. Now, if you have a lot of debt and huge overdrafts, they may sit there and think that, do you know what? This person is going to be a risk. They're probably not managing their debt. They might have defaults. That's the worst thing you could have. You've not paid a credit card payment, for example, and then they'll just refuse to lend to you. But it will have an impact. So that's why way ahead of applying for a mortgage, you need to get a handle on your credit. Find your credit report, make sure it's correct, make sure all the information is correct on there. We'll explain to you how to do that via our Money MOT. So go on to moneytothemasses.com, sign up for the Money MOT, and one of the key parts of that is actually getting in control of your credit report. You don't have a universal credit score, that's a myth. Each lender does their own credit scoring of you. But what will happen is if you can manage your debt well, you pay regularly, set up direct debits, you never miss a payment, because missing a payment on a credit card has a huge impact on whether you will be able to get a mortgage in the future. And also managing your debt, generally speaking, as again another rule of thumb, if you manage to keep your balance of your debt to around 15% to 30% of the available credit you have, then that's seen as being well managed by lenders, rather than being right up to the limits that you're actually you could possibly borrow. So try and keep it managed well. And if you want to find out more information, you can do so on moneytothemasses.com.
So just quickly, if someone now watches this and goes, oh no, I've maxed out 2 credit cards and I'm in my overdraft, but they're paying over what the regular payments are, or are making regular payments, would you sort of say to them, don't panic, it doesn't mean that getting a mortgage or having a decision about a mortgage is that far off, because you are overpaying on that debt. So it's not far out of reach for you to get a house. You can still get there, but you just have to show a conscious effort that you're paying off and you're managing your money, and that you're not it's not spiraling out of control.
Yeah, there's an element of that, but the reality is, if you've got loads of debt, people aren't going to want to lend you any more money. It's a bit like if you had a friend, would you lend your mate who goes down the pub, who already owes you 200 quid, another 50 quid? You probably wouldn't. It's the same idea, but the fact that you're paying it and you're overpaying and you're managing that debt is a positive, but you still need to get that debt down. So it may mean it's further off, but the fact you've got a plan is, like you're saying, the real positive of the whole thing. So you're actually got a plan, it's in place, and you're taking control. The worst thing you can do is bury your head in the sand.
Okay, so that's everything for this week's Millennial Money video. Thanks again for everyone who sent in their questions. And just remember, if you have anything else that you want me to ask Damien next week, just send me an email at lauren@moneytothemasses.com, or head over to our social media pages, our Facebook, Twitter and Instagram @moneytothemasses, and our Twitter has @moneytothemasses with the number 2.